Geopolitical tensions have fundamentally altered how global financial markets operate and respond to uncertainty. Traditional safe haven assets no longer provide the security investors once expected. Currency volatility has increased dramatically as nations weaponize their monetary systems. Trade wars create supply chain disruptions that ripple through commodity markets. Military conflicts generate resource scarcity that drives industrial metals demand higher. Economic sanctions fragment international payment systems and create alternative trading arrangements. Silver has emerged as the critical metal at the intersection of these geopolitical forces. Unlike gold, silver serves both monetary and industrial functions simultaneously. This dual demand profile creates unique market dynamics during geopolitical stress periods. Industrial users cannot easily substitute alternatives when silver becomes scarce or expensive. Investment demand accelerates when currencies lose credibility or purchasing power declines. Military applications require silver for electronic components and advanced weapon systems. The current geopolitical landscape shows unprecedented complexity with multiple conflict zones operating simultaneously. Eastern European tensions affect global grain supplies and energy distribution networks. Middle Eastern instability influences oil prices and regional trade relationships. Asian territorial disputes impact semiconductor supply chains and technology manufacturing. African resource conflicts disrupt mining operations and commodity exports. Each conflict creates ripple effects that ultimately influence precious metals demand. Central banks worldwide have responded to geopolitical uncertainty through unprecedented precious metals accumulation. Official sector gold purchases reached record levels during recent geopolitical escalations. Central banks recognize that traditional reserve assets become vulnerable during sanctions regimes. Physical precious metals provide neutral reserve assets immune to financial warfare. Silver purchases by central banks remain limited, but show increasing trends. The weaponization of currency systems has accelerated international movement toward precious metals. Dollar-based sanctions demonstrate the risks of excessive dependence on single currencies. SWIFT payment system exclusions affect international commerce and trade settlement. Alternative payment systems require neutral assets for international value transfer. Precious metals provide settlement mechanisms independent of political control or manipulation. Industrial silver demand creates inelastic consumption that operates independently from investment considerations. Electronics manufacturing requires silver for conductivity applications that have no substitutes. Solar panel production consumes substantial silver quantities for photovoltaic cell construction. Medical device manufacturing utilizes silver's antimicrobial properties for surgical instruments. Automotive electronics increase silver consumption as vehicles become more computerized. Military applications demand silver for radar systems and missile guidance technology. Supply chain disruptions from geopolitical tensions affect silver mining operations globally. Mining equipment imports face delays due to trade restrictions and sanctions. Energy costs for mining operations fluctuate with geopolitical energy market impacts. Transportation networks experience delays that affect ore shipment and processing schedules. International labor mobility restrictions limit technical expertise availability for mining operations. Environmental regulations increase compliance costs for mining companies in unstable regions. The psychological aspects of geopolitical risk create momentum effects in precious metals markets. News cycles amplify uncertainty perception even when actual impacts remain limited. Social media accelerates fear transmission and creates herd behavior among investors. Political rhetoric escalates tensions beyond economic or military realities. Market participants often overreact to geopolitical developments before reassessing actual impacts. These psychological factors create volatility that exceeds fundamental supply and demand changes. Silver's unique position between monetary and industrial assets creates complex price dynamics. Monetary demand typically increases during geopolitical uncertainty as currency confidence declines. Industrial demand continues regardless of geopolitical conditions because production processes require silver. Investment demand can surge rapidly when geopolitical events trigger safe haven buying. Speculative demand amplifies price movements when psychological thresholds approach or break. These multiple demand sources interact unpredictably during geopolitical stress periods. The mathematical relationship between supply and demand becomes critical during geopolitical crises. Silver supply faces constraints from mining disruptions and processing facility limitations. Demand increases from both industrial requirements and investment safe haven buying. Small supply deficits create disproportionate price responses in tight markets. Inventory drawdowns accelerate when multiple demand sources compete for limited supplies. Price volatility increases exponentially when supply-demand balances reach critical points. Physical silver markets behave differently from paper markets during geopolitical tensions. Paper silver contracts depend on financial system stability and counterparty reliability. Physical silver provides tangible assets independent of financial system functionality. Delivery mechanisms face disruption when transportation networks experience geopolitical interference. Storage locations require political stability and secure access for inventory management. Insurance costs increase substantially when geopolitical risks threaten storage facilities. The $100 silver price level represents a critical psychological threshold. Round numbers create psychological anchoring effects that influence investor behavior patterns. Media coverage intensifies when precious metals approach historically significant price levels. Algorithmic trading systems often incorporate psychological price levels into execution strategies. Options markets show increased activity around round number price strikes. Technical analysis places emphasis on psychological resistance and support levels. Market structure changes occur when psychological price thresholds break decisively upward. Retail investor attention increases dramatically when media reports record price levels. Professional investors often reduce positions when retail enthusiasm reaches extreme levels. Volatility typically increases around psychological price levels due to concentrated trading activity. Momentum effects can accelerate price movements beyond fundamental justification when thresholds break. These structural changes create feedback loops that amplify initial price movements. Supply constraints become more apparent when silver approaches significant price thresholds. Mining companies cannot rapidly increase production even when prices provide economic incentives. Processing capacity limitations prevent immediate supply response to higher price signals. Transportation bottlenecks limit distribution efficiency when demand surges create logistics pressure. Inventory levels decline when consumers accelerate purchases anticipating further price increases. These supply constraints support price advances once psychological thresholds break. Demand acceleration occurs when investment psychology shifts toward precious metals ownership. Individual investors typically increase allocation percentages when prices break significant levels. Institutional investors may adjust portfolio weights when assets demonstrate momentum characteristics. International investors seek precious metals exposure when domestic currencies experience weakness. Speculative traders increase position sizes when technical breakouts suggest continued advances. These demand increases create positive feedback loops that support higher prices. The timing of geopolitical events relative to precious metals market cycles affects impact. Geopolitical crises during precious metals bear markets often create temporary rallies. Events during bull markets can accelerate existing trends beyond normal parameters. Market positioning before geopolitical events determines the magnitude of price responses. Seasonal factors influence how geopolitical tensions affect precious metals demand patterns. Economic cycle phases determine whether geopolitical tensions create inflation or deflation. Regional geopolitical tensions affect silver markets through different transmission mechanisms. Asian conflicts impact technology sector demand for industrial silver applications. Middle Eastern tensions influence energy costs that affect mining operations profitability. European disputes affect trade relationships and currency stability preferences. African conflicts disrupt mining operations and reduce global supply availability. American tensions influence regulatory policies and domestic demand patterns. The correlation between geopolitical tension intensity and precious metals performance varies. Minor diplomatic disagreements typically generate minimal precious metals market response. Military conflicts create immediate safe haven demand that supports price advances. Economic warfare through sanctions generates currency concern that benefits precious metals. Trade disputes affect industrial demand patterns but may reduce investment demand. Nuclear tensions create extreme safe haven demand that overwhelms normal supply. Energy market interactions with geopolitical tensions create secondary effects on silver. Oil price increases from geopolitical tensions raise mining costs and reduce profit margins. Natural gas supply disruptions affect industrial silver users and processing facilities. Renewable energy investment increases silver demand when energy security becomes priority. Electricity cost volatility affects mining operations and smelting facility profitability. Energy infrastructure security concerns increase industrial silver demand for grid applications. Currency market responses to geopolitical tensions directly influence precious metals demand. Dollar strength during geopolitical crises can temporarily suppress precious metals prices. Euro weakness from European tensions increases European precious metals buying. Yen volatility affects Asian precious metals trading and investment flows. Emerging market currency weakness drives local precious metals demand increases. Central bank intervention in currency markets affects precious metals as alternative. The technology sector's dependence on silver creates vulnerability during geopolitical tensions. Semiconductor manufacturing requires stable silver supplies for production continuity. Consumer electronics production faces disruption when silver prices increase rapidly. Telecommunications equipment manufacturing uses silver for connectivity applications and components. Defense technology applications demand silver for radar and guidance systems. Space technology requires silver for satellite components and communication systems. Medical device manufacturing creates inelastic silver demand during geopolitical uncertainty periods. Surgical instruments require silver coating for antimicrobial properties and patient safety. Hospital equipment uses silver components for infection control and device reliability. Pharmaceutical production utilizes silver compounds for certain medication formulations. Medical implants incorporate silver for biocompatibility and antimicrobial characteristics. Emergency medical supplies often contain silver-based materials for field treatment. Financial system stress during geopolitical tensions affects precious metals market structure. Banking system disruptions can affect precious metals financing and trading operations. Payment system restrictions impact international precious metals trade and settlement. Credit market stress affects mining company financing and expansion capabilities. Interest rate volatility influences precious metals investment attractiveness relative to bonds. Stock market corrections often coincide with precious metals buying as portfolio insurance. The precious metals derivatives market behaves unpredictably during geopolitical crises. Futures contracts may disconnect from physical market pricing during extreme events. Options volatility increases dramatically when geopolitical tensions escalate toward conflict. Exchange-traded funds face redemption pressures that can affect underlying markets. Over-the-counter derivatives may face counterparty concerns during financial stress. Margin requirements often increase when volatility reaches extreme levels. Retail investor behavior patterns change significantly during geopolitical tension periods. Coin and bullion dealers report increased sales when international tensions escalate. Online precious metals retailers experience website traffic surges during crisis events. Local dealers often face inventory shortages when public buying increases rapidly. Precious metals storage companies receive increased inquiries about secure storage options. Investment advisor consultations increase when clients seek portfolio protection guidance. Institutional investor responses to geopolitical tensions follow different patterns than retail. Pension funds often increase precious metals allocation percentages during uncertainty periods. Insurance companies may adjust investment portfolios towards safer asset classes. Sovereign wealth funds sometimes increase precious metals holdings for geopolitical diversification. Hedge funds may increase precious metals exposure as portfolio hedging strategy. Central banks accelerate precious metals purchases when international tensions affect currencies. The international trade implications of geopolitical tensions affect silver markets indirectly. Import restrictions can affect precious metals, supply chains, and availability. Export controls may limit precious metals access for certain countries. Tariff policies influence industrial silver users and manufacturing cost structures. Trade agreement modifications can change precious metals demand patterns geographically. Shipping route disruptions affect precious metals transportation and delivery timing. Military spending increases during geopolitical tensions create additional silver demand sources. Defense contractors increase precious metals procurement for weapon systems production. Electronic warfare capabilities require silver for radar and communication systems. Missile guidance systems utilize silver components for accuracy and reliability. Naval systems incorporate silver for marine environment corrosion resistance. Aerospace applications demand silver for satellite and aircraft electronic systems. The storage and logistics infrastructure for precious metals faces challenges during conflicts. Vault security requirements increase when geopolitical tensions affect regional stability. Transportation insurance costs rise when shipping routes face geopolitical interference. Border crossing procedures become more complex when international tensions escalate. Storage location diversification becomes important when single regions face instability. Emergency access procedures require planning when normal logistics face disruption. Market sentiment analysis becomes more complex during geopolitical uncertainty periods. Traditional sentiment indicators may not reflect geopolitical risk premiums accurately. News flow analysis requires distinguishing between rhetoric and actual policy changes. Social media sentiment can amplify geopolitical fears beyond realistic threat. Professional investor positioning may not align with public sentiment measurements. Contrarian indicators become less reliable when genuine risks support popular sentiment. The timing considerations for precious metals investment during geopolitical periods require careful analysis. Early-stage tensions often provide better entry opportunities than crisis peaks. Market response patterns vary depending on the specific type of geopolitical risk. Duration uncertainty affects whether temporary positions or long-term holdings perform better. Multiple simultaneous conflicts create different dynamics than single regional tensions. Resolution timing uncertainty complicates exit strategy planning for geopolitical trades. This analysis examines how geopolitical forces influence precious metals markets rather than predicting specific outcomes. Silver's unique position between monetary and industrial applications creates complex dynamics. Understanding these relationships provides context for market behavior during uncertain periods. Geopolitical events remain inherently unpredictable in timing and magnitude of impact. Investment decisions must incorporate geopolitical risk while maintaining appropriate diversification and risk management.